Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Monday, October 20th. Welcome back to me and to you. Thanks for joining me here today. Hope you had a wonderful weekend and a great end of last week. We're coming to you from a classically rainy fall day here in Redmond, Washington. And I hope you guys are doing well and staying safe wherever you're at. We just got back from the Money Show in Orlando on Saturday. Had a great visit with a number of the other speakers, met a number of you in the exhibit hall and at my presentation, and I thank you guys that came and said hey while we were there together. Great to compare notes with some of my fellow speakers and sort of see where everyone was at. To be honest with you, if I would summarize the general vibe I got, sort of a short term, things are messy. Long term, there's still plenty of things to be optimistic about. And that was sort of the general takeaway. And that's kind of how it's felt from my side, right? We can talk about tactical pullbacks. We can talk about if short-term levels would break, what would come next. But there would have to be a lot more deterioration to be anything less than, I think, fairly constructive about the long-term story. But I think there's a difference between having a long-term sense of market conditions and a secular tailwind for growth versus the short-term issues when you start to see signs of deterioration that suggest we're going to have some sort of corrective move. Now, with all that in mind, Friday kind of a decent update, and today a fantastic update with the S&P closing above 67.35, bouncing off of support. Our line in the sand at 65.50 has not been violated. So as promised, I think the market trend is positive until proven otherwise, or as we would say, innocent until proven guilty. If you're wondering why we're a couple minutes late today, AWS just absolutely torpedoing my day. I'm sure many of you might have been affected as well when we learn how many websites and web-based products are based on Amazon Web Services. So when it goes down, as it did in the early hours of Monday morning, Eastern time, things get crazy. I have a to-do list that I manage on a website, and didn't get to it until about 30 minutes ago. So not a productive day, I would say. And the charts weren't working great until about 25 minutes ago. And all of a sudden the charts started to work pretty well. So I said, all right, let's do this. Let's do the show. So if we have any weird, glitchy chart related issues, we can all blame Amazon Web Services. By the way, Amazon, even with their wonderful cloud-based platform, absolutely wrecking most people's productivity today. Stock's still up 1.6%, so it's not all bad. All right, let us get to the chart, shall we? We'll do a quick chart review. We'll do the market dashboard or the heat map and talk about how things played out. We'll get to a couple charts here to finish things off. We'll call it a Monday afternoon. All right, the S&P 500 up 1.1% to 67.35 and change. Decent recovery after last week's, choppiness, right? We have elevated volatility. Certainly you can see the daily price movements on the major indexes, kind of more than average, right? How long has it been since we've seen a series of days with like 1+% moves, even 2% moves during the day? It's been a while, but that's been the story here for the last week. I actually have a chart showing you the S&P versus the VIX, so you can see what a higher VIX is really representing, right? It really represents an expectation that we'll have more volatile conditions, and that's certainly how things have not disappointed for sure. The Dow up about 1.1%, the Nasdaq up 1.4%, mid cap, small caps, everything up. Small cap S&P 600 up the most, up 1.6%. So the return of small caps, maybe it's still alive and well. We'll see. We'd have to see quite a bit more improvement, certainly in the breadth area, for me to be a big believer in further upside there. But for now, decent update. Volatility, the VIX moving lower by about 2.5 points going into the weekend. The VIX finished the week just above 20, so spent most of last week above 20, which is a high volatility environment. Today, moving back lower, finishing today just above 18. So we're now, by my very basic back of the envelope proprietary formula, is the VIX above or below 20 is what I'm doing. VIX below 20, low volatility environment. So strong update today, volatility coming in. Market showed a lot of confidence going into the meat of earnings season. We've got two of the Mag 7 names, Tesla and Netflix, reporting this week. others coming next week and beyond. But so far, decent earnings season. All right, let's get some of the other areas of the market, other asset classes. So bonds generally moved higher today. You can see the TLT was up about 0.4%. The TLT is actually getting to the upper end of a range that's been in place really for much of 2025. I'll show you that chart in a little bit, and you can see what I mean there. And all that means is we're going up into a well-established resistance level, which means you really want to see, you need to see positive momentum to be able to get above that threshold that we've been unable to get above here in months and months. The last couple of peaks have been right around that same price point, right about where we're at today. Rates generally moving lower, of course, with the government shutdown still in play. And I've seen rumors that maybe there's some deal happening this week, but I have not seen any specifics along those lines. So what that means is still not a lot of economic data coming out. However, they did announce that Friday we'll get the September CPI number. So that will be one crucial piece of inflation data going into next week's Fed meeting, the next to last, the penultimate Fed meeting in 2025, where the Fed is generally expected to lower Fed funds target rate by 25 basis points. So today, rates moving down, sort of generally in anticipation of that. We can see bonds have generally been trending higher. So the stock to bond ratio is actually kind of choppy sideways in the last month. Dollar slightly higher, but not too much to be worried about here. All right, looking at the commodity space, the DBC up 1%. That's a broader commodity ETF with a lot of energy. If we look at just the precious metals, I mean, the uptrend in gold and silver continues unabated. GLD above $400 a share, I think, for the first time. Gold above probably $4,300 an ounce, I would say, with that move. Silver up with the SLV up 1.6%. Copper prices are higher. I had a question from one of my premium members over the weekend about lithium, copper, rare earth metals, all of those ETFs. Right around the 21-day EMA, by the way. Certainly something to watch here. Natural gas prices spiking higher, but the rest of the energy space kind of rough. I would say the energy sector is still not particularly a good opportunity by my read until you see an improvement in crude oil prices. Not there yet. Now, Bitcoin has gotten really low, and over the weekend, Bitcoin got down to 104,000. Did bounce higher through yesterday, and through the equity trading session today, Bitcoin has accelerated to the upside, currently trading just above 111,000. It's a nice recovery off of those lows. Still a vulnerable chart unless we can hold support. We actually bounced right off a key Fibonacci level. I think I kept that chart so we could review that here in a moment. Ethereum prices just pushing above 4,000 here as we go live on Monday afternoon. All 10 of the top coins on the stock charts platform in the green today. All right, looking at the 11 S&P sectors: materials, industrials, financials, communication services, technology, energy, healthcare, and real estate. That's 8 sectors, almost identical returns, up about 1.1, 1.2% today. So everything kind of drifting higher. Not a huge up there. It wasn't a big leadership day where one of the sectors kind of left them all behind. We've seen that sort of thing before with like technology up or utilities up and kind of other things struggling. Today was kind of everything bouncing higher to start the week. Only 2 sectors down, and the 2 defensive ones, consumer staples and utilities. Honestly, they were basically flat for the day. No real, nothing really negative there. All right, looking at the breadth was positive today. Now, breadth going into last weekend was not great, and that's been one of the key bullet points when I think about reasons to not be wildly optimistic about this market. Weaker breadth conditions, persistently weak breadth conditions are a major concern, right? Less than 50% of stocks above their 50-day moving average, lots of bearish rotations in the advanced decline lines, things we've been covering here for quite some time. If we look at the advanced decline data, we can see 80 to 85% advancers for most of these indexes, with the S&P over a 4-to-1 ratio, stocks up versus down, about the same in the New York Composite Index. That's a strong update. That is a decent update to start this week. Days like this give me a reason to not be too negative, right? When you have positive breadth on a day like this, when you kind of have everything drifting higher, volatility going down, that's super encouraging, super encouraging. let's see if that can be sustained. And as always, as we've talked about, S&P holding our level of support, which it has, we're generally going to be constructive until that changes. All right, the Magnificent Seven and friends, some leading growth stocks that are so very important. As I mentioned, two of these reporting earnings this week. You've got Netflix, which is up 3.3% going into the earnings report. Tesla up 1.9%. Out of these, this basket of 8 or so names, I mean, the one that stands out to me, to be honest with you, is Tesla. Nice breakout, pull back to short-term support. I think it's hitting right on the 21-day EMA, maybe rotating higher going into earnings. That's a super decent setup. Apple and Netflix both up over 3% today, which is encouraging. So the only ones that did not do particularly well, you've got NVIDIA and Broadcom, the two semiconductor members of this bucket of leading growth names. You've got NVIDIA down about 1/3%, Broadcom basically flat. I mean, Microsoft not great. It's bouncing after closing higher on Friday, kind of following through today. These aren't particularly strong charts at the moment, at least in the tactical time frame. You need to see if they can show more signs of accumulation. It's worth noting that big tech, kind of at the bottom of the list, besides Apple, which had a pretty good day, but some big market cap in the technology sector, standing guard at the bottom of the leaderboard today. All right, we will go to the market carpet here in a moment. As a reminder, we're live streaming on a couple platforms. We are available to take your questions anytime. We get to very few questions through our normal show here. We usually try to do an all mailbag episode on Friday. Apologies, I didn't get a good show out at the end of last week. However, I did get 2 pieces of content out that I hope you will check out. Number one, we did a special video on the Hindenburg Omen last Friday. It's gotten a lot of great attention, and I would encourage you to check it out on my YouTube channel. We talked about, really broke down the story of this indicator, the particular components, what it means that we had an initial signal, a week and a half ago, what we'll be looking for here in the remainder of October, beginning of November to validate that signal, what's happened in previous market topping periods where we've had a valid Hindenburg Omen sell signal. So make sure you check that out, because I think that could be an important piece of information to be following here. We'll certainly be checking in on the chart here on the show. Also, great interview with Tom Atkinson of FX Evolution. I met Tom a number of years ago at a conference, have kept in touch with him. He has a very popular show on YouTube with great viewership and well-deserved. He is a smart guy looking at charts in brilliant ways, talking about macro conditions, but really focusing on the charts as well. Many people mentioned in the comments they've been following his show for a while. I hadn't actually seen him because we did a video interview. So check it out. You can see what Tom looks like and also reflect on what a nice guy he is, and also a really thoughtful trader and strategist. So that's the latest episode on our Market Misbehavior podcast. We did record a couple episodes of the podcast from the Money Show in Orlando, working on getting that content to my editor here soon. So hopefully we'll get him to you later this week, and have a number of other episodes that we have scheduled after meeting with the speakers down in Orlando. So a lot of good comments or good content coming your way here on the Market Misbehavior podcast. All right, looking at the heat map, I mean, decent day, right? A couple things to observe here as you see a generally positive day for stocks. Obviously, number one, some bright green in technology, particularly Apple, AMD, which is certainly one of the semiconductors making new all-time highs today. Salesforce, which has been arguably one of the worst charts in the technology sector, up about 4.6%. I would argue still quite a bit to prove before that looks like a great chart. But I have to reflect on the stock bouncing higher today. Intel making new all-time highs. KLAC making new all-time highs. CrowdStrike not quite there, but did get slightly above $500 a share. That's the good news. The bad news, Western Dig and Seagate, which are two hard drive manufacturers. These are the ones that make all the memory that we need for all the cool stuff that we're doing with all this great technology. Both of those stocks have been pulling back. Had a nice bounce last week, but today kind of almost resuming the downtrend that we had before there. AppLovin, ticker APP, has now followed through below 600. It was at just above $700 a share at the end of September, but rotating lower as well. But the big bright red that you see here that I'm concerned about is in the upper right corner. A lot of technology stocks, right? If you look at like AMD, encouraging chart, right? Gaps higher, moves higher, following through to the upside. Oracle kind of doing the opposite. Hit a peak around 375 in September, ended up being sort of a double top pattern with multiple tests of that resistance, pulled back last week, popped above $300 a share, but not holding it. Today, actually rotating back lower below support. Outside of the technology sector, communication services overall looking pretty good. A number of these charts like Meta are ones we've highlighted that look vulnerable, and you want to make sure that they hold support. For Meta, it's like that $700 level. Those are the lows from July. We're kind of right back to that point after making a peak in August, kind of round trip back to that support. So I'd certainly want to see if that could hold. Pretty decent day in the financial sector, which I would say is, healthcare. I'm thinking financials and I'm looking at the wrong box here. Within healthcare, if you look at a number of these areas, like Charles River is one that stands out to me, right? When you're looking at the technology sector, it's filled with a bunch of things that have kind of been in really good uptrends. And the question is, do they continue or not? Or things that have been absolutely beaten down, like Salesforce.com. You're trying to debate whether they're going to recover. Healthcare has a bunch of charts that are maybe earlier on in an improving trend. So, for example, with CRL, we can see a blow off above the 200-day moving average in July. We failed soon after, got back below the 200-day. We've sort of toyed above and below the 200-day moving average through August and September, but the nice acceleration to the upside here in early October bumps into resistance at 180. That was the peak from July. That was the peak from earlier this month. Today, finally getting above there, showing up on the new 3-month highs list if you run that scan like I do as often as you can. So certainly seems to me like CRL is one of those charts breaking out above the 200-day moving average. And this move seems to have staying power, right? You have the gap up. We have the pullback above the 21-day EMA, the rotation higher. I think that's a strong improving chart. So the healthcare sector full of charts like that are less like, boy, these have been great charts for quite some time, and you're just seeing if the uptrend continues. A lot of these are ones that are maybe earlier on in the move. They're not all great. So I would say for every CRL, there are other charts that do not look as obviously positive. But charts like Hologic and others getting above the 200-day, holding above resistance. That's what you want to see when you see any of these names kind of breaking out there. On the downside, outside of the technology sector, I mean, one observation would be in the financial sector, which is what my mouth was saying as I was looking at healthcare a few moments ago. Note how the insurance companies are struggling here. Now, Progressive has been a pretty rough chart for the last 6 months. I mean, it's making the new 52-week low today, but that's been in a downtrend for quite some time. But there are a number of other insurance names that were showing some vulnerability last week, like Chubb CB is one of those. It was looking very, very strong. But if you draw trend lines off of the major lows through the summer, we seem to be breaking below their, end of last week and not really getting a nice improvement here today. So within the financial sector, it certainly seems like the banks and other type of names above, insurance, which has been struggling. Yeah, I think that's it, right? When we're looking at the heat map, I mean, overall, pretty decent day. We didn't talk about consumer staples, utilities, which looked weaker than average. Within consumer discretionary, one other point here is beside Amazon and Tesla, if you kind of cover those two boxes up, there are a lot of really ugly days today. Not horrible days, not end of the world days, but like down 0.5% to 1%. So just not matching the optimism that we had from the major averages. All right, let's look at some charts together. I'll take a question or two. We'll call it a day. All right, we'll start with a chart of the S&P 500, as we often like to do here at the beginning. The way that I approach a market like this, just to reiterate, right, I tend to make a very basic assessment when I bring up any chart. And the initial assessment is this chart going up, down, or sideways? Or how I think of it, a period of accumulation, period of distribution, a period of consolidation. There's a bunch of tools we can use to make that a very systematic assessment. But if you looked at enough charts for enough years, the moment you bring up the chart, you can kind of see, the SP is in a primary uptrend, higher highs, higher lows, moving averages sloping upwards. This is pretty good. So then the question is, what would change, right? What would I need to see on this chart to think this is no longer an uptrend? And I think that basic assessment of define the trend, just start to think about what would make the trend look different, right? What would be that red flag you'd be looking for. And for me, I think it's very straightforward right about now. You have the 50-day moving average. You have the recent swing lows around 65.50. So that's the level for me. We talked about that level for quite some time, which is why the pullback that we had, the big sell-off that we had a couple Fridays ago, right to that line in the sand, for me, that's like we're still okay as long as we hold it. Tuesday, the week after, when we held the 50-day and held 65.50, I think we're still okay. And that means today, as we're bouncing off of that level, we're still good, right? The bullish outcome here, right? The bullish scenario, if Q4 ends up being just this brilliant uptrend and the S&P blows out above 7,000 and just keeps going, we pull back to the 50-day moving average, and that's about it, right? Then otherwise, the market should continue to go higher, and today should lead to further gains as we push to new all-time highs. Not quite there today. The bearish scenario, of course, all large losses begin as small losses. So we look at those short-term support levels and see if they hold. And if not, then we have to start thinking about, all right, what's the probability that we go further, that we have more of a significant drawdown? And what are some of those levels where I may take a speculative position buying on a short-term reversal? So for now, market in a period of accumulation, uptrend is still in play. We're still above the 50-day. We're still above our line in the sand at 65.50. I'll get less optimistic when those things that I just said are no longer true. Now, the S&P 500, by the way, if you look at the VIX, which is in the bottom panel, here's the S&P in the top. Here's the VIX on the bottom. What does the VIX actually mean? What you have to remember is the VIX is a volatility index calculated from the S&P 500 options, the index options. I'm not going to get into the math of it, but basically the higher the VIX, the higher the expected movement in the S&P. It's an implied volatility, basically, right? So we're looking at the volatility in the options market to sort of infer or estimate what a volatility should be for the S&P itself. So when the VIX is below 20, we should be having minimal big moves, right? The average day should be kind of small. We shouldn't have a lot of big 1 to 2% up or down days. Low volatility implies low movement day to day, which means when the VIX spikes above 20, this is kind of what you're expecting, right? Just look at the daily range back here in August and September. Look at the daily range we've had in the last week and a half of October. This is what a high volatility environment looks like on the chart. This is what a low volatility looks like on the chart. So what's interesting is, in some ways, if you look at the chart of the S&P enough, you really don't need the VIX. You could probably guess when the volatility is spiked. And looking at this chart, you can probably quickly identify, yeah, these are the two periods where the VIX is probably above 20. And sure enough, that's where it is. So there are some specifics about what the VIX is telling us in terms of the actual value and the expected move. But all I would say is above 20 means a noisier environment, means expect movements of 1 to 2% day in, day out, because that's what the higher volatility is really telling us. It's not telling us the market's going to go up or going to go down necessarily. High VIX just means big movement. Now, the reality is most of the time when you have big movements, it's more often down days than up days, right? Because people panic and they panic sell. They don't panic buy as much, right? That's not how the market kind of goes. Or as one of my mentors used to say, the market takes the escalator up and the elevator down, right? So you have big movements on down days, which is why volatility spiking usually means we're in a period of distribution. But the fact that the VIX is elevated until today, where it's going back above 20, if the VIX would get above 20 and stay there, that means this is more the norm and not these kind of quieter days that we observed earlier in the fall. All right, looking at breadth conditions, improving today. As we mentioned, today was a nice positive day for breadth, which is a wonderful relief after last week was overwhelmingly generally negative breadth. We did get slightly above 50% of S&P 500 members above their 50-day moving average, right around 53% at today's close. That's encouraging. We're around 65% of stocks above their 200-day moving average. Look how that really hasn't changed a whole lot. And that's, I think, this chart right here, I think is a great way of me, for me, kind of summarizes what I'm seeing in the market. The long-term trend is still fine, and the long-term breadth is still good. So if I just kind of take a step back and look at the general trajectory of the markets and look at the fact that about 2 out of every 3 S&P stocks are still above their 200-day moving average, those are bull numbers. Those are bull market numbers. But in the short term is where we start to worry, right? stocks above their 50-day moving average breaks below 50%. If the S&P would break its 50-day moving average, as we mentioned a chart or two ago, that's where the short-term chart looks more vulnerable. So, still, I would see any deterioration for now as short-term weakness within long-term strength. And I think you have to break down quite a bit further before the long-term indicators would look a little more negative. Gold continues to go higher. I'll continue to reiterate, I've got a position in GLD and IAU. I mean, I've been trimming that on the way up just because I don't want it to be my entire I don't want to call my portfolio the Dave Keller Gold portfolio. And that's the risk when you have something like this that just keeps accelerating. Having a big bet in something that's working, I don't have a problem with. Having a ridiculously and uncomfortably big bet, and that's what happens when something continues to improve. So just trimming some, right, and sort of bringing it back to a reasonable allocation and reallocating that capital into other areas of emerging strength, I think is a really good way to play this particular kind of market, given the uncertainty we have with stocks, given the fact that we've seen a lot of red flags about the market conditions here in mid-October for equities. I'm still happy owning things like this that are going up, but I don't want to make that my entire portfolio. I don't want to make it a huge percentage. So you trim it down and you put things in other areas of the market where you do need, where you maybe do want to add exposure. From a trend following perspective, though, long and strong, up and to the right, making higher highs above the 21-day EMA. There are indicators that I don't use often that are based on the percent away from a moving average. That indicator, that number is pretty high for the S&P right now. Just look visually. Here's the 200-day in red. Look how far we are, about 100 points above the 200-day moving average. That's about 30-some% off the 200-day compared to like back here in September, October of last year, where you're at 255, you're like 40 points, you're about 15-20% off the 200 days. So we've accelerated quite a bit. We can see how the moving averages are spreading out. We can see that the price is very far from the 21-day EMA. The problem here is if we would get some dramatic sell-off in gold, it's going to take 35 points just to even touch the 21-day EMA, which means we're already down 8 to 9% just to get down to the 21-day exponential moving average. That's how much this is accelerated. Certainly speaks to the fact that the dollar is not particularly strong, and gold hard assets continuing to get a bid. Obviously, a lot of discussion about big institutions, big sovereign funds building up positions in gold. Price of gold reflecting that demand for sure. All right, let's talk about Bitcoin. Right, Bitcoin has been in a vulnerable position after failing to hold above 125,000 earlier in October. We bounced down to the 200-day very quickly off of that previous all-time high. We then once again tested the 200-day over the weekend, and today kind of bouncing off nicely. I mean, obviously, this is what you want to see. You don't want to see any further deterioration at this particular moment. I don't have the Fibonacci retracements that I really want to have, so I'm going to draw them. Let's do it right now. We'll make these, pink is fine. We'll make it a little thinner. We start at the April low. We go to the July peak. And a quick Fibonacci lesson here as we look at just a couple more charts to finish the discussion. Quick Fibonacci lesson. How do you select which levels to use? So to be honest, this is the subjective part of using Fibonacci retracements. I always tell people, stick with meaningful highs and lows. Don't just pick some random level because it's an interesting one. Pick the ones that have meaning, right? So that low in April to that high in May, I could see that to think about support levels there. This low in April to that peak in July makes sense to me because I see this as just a retest of that July high. And so once we've selected that, kind of made that framework, 38.2% of the way down right here, 104,550 or so. It's literally the low. I mean, we trade a little bit below it, but price bounced off of that level. You buy at that first Fibonacci level, you're feeling pretty decent here as we have that initial bounce. I think Bitcoin below 104,000, pretty ugly. I have a decent position in Bitcoin directly, but also with things like GBTC and IBIT and other Bitcoin ETFs. Bitcoin below 104,000, personally, I'll start lightening up that position as well, because the history of Bitcoin has had some pretty major league drawdowns. That is not unusual. Actually, not having one would be way more unusual than having one. So I'm happy getting out of the way when needed. All right, here's the chart of the TLT just to show you we're at the upper end. From a technical perspective, we're in this big kind of sideways pattern, and we've been in that for about a year now, right? Go back to October of 2024. This is around 91.50 on the TLT. The support is around 82.50, which comes from April of last year. We can see how once you set those levels, we've bounced above, bounced up to resistance. We've bounced down to support. We kind of retrace. We're kind of right back up to this resistance. So in this kind of environment, as we near the overbought condition, testing previous resistance, I would expect two things. Number one, you'd usually expect at least some sort of pullback on a well-established resistance level. So that's what would be sort of my base case, is at least some sort of pullback. However, it also means if and when you get a valid break above 91.50, above 92, clearing that level, that would indicate quite a bit of strength for the bond markets. And this is what the price, right? This is what we're looking at, the price of bonds, not the yield of bonds. That would be like the 10-year Treasury yield. This is looking at bond prices, the return on bonds, and overall improving quite a bit. The strength in the TLT is what's making the stock to bond ratio relatively sideways. You really haven't gained much owning stocks over bonds in the month of October. They've really been, sort of in line with one another. All right, NVIDIA, one of those technology names, not doing well today, down about 1/3%. That's not a horrible day, but right at the 50-day moving average. We have a couple sort of, false breakdowns of the 50-day in September. We're kind of right back to that level. As long as we hold that, I think this chart is really good. We stop holding that, we're unable to hold that, I think that would be a major issue. So kind of 180, 175, 180 on NVIDIA, pretty important support level that we're testing right here. Amazon kind of doing the same thing, but instead of the 50-day, we're testing the 200-day moving average. Amazon, thanks again for the dramatic AWS outage that caused all sorts of websites to be torpedoed. But hey, we all survived. I got some reading done. That's good. When you can't look at charts or look at your task manager. Good reading. That's good. From a technical perspective, does Amazon hold the 200-day? I think that is such an important question. The strength in this market has to be dominated, or has to be defined by the strength in these mega cap stocks. By the way, I did the presentation in Orlando for the Money Show, and if you missed it, one of the things we talked about was I asked everyone to guess the weight in the S&P 500, the top 10 stocks in the S&P, what sort of weight that is. And if you run the numbers, it's just over 1/3. It's currently around 38-ish%, I want to say. And what that means is if you think of the S&P 500, the 500-ish stocks, the top 10 are about 1/3, a little over 1/3 of the weight of the index. So those top 10 stocks make up about 1/3 of the weight. The next 40 stocks, to round up the top 50, the next 40 are the next third. And then the final 450 stocks make up the bottom third of the weighting. That's how big a weight the mega cap stocks have, those Mag 7 stocks. And that's how much weight the top 50 names have relative to everything else, which means even if the S&P and the NASDAQ go down, there could be plenty of stocks doing quite well. They're just not a big enough weight in the index to move the needle on the S&P. The S&P is going to tell you more about big cap growth and the Mag 7 trade than anything else. All right, Tesla, by the way, holding the 21-day EMA. I think is a pretty important kind of short-term threshold. One of two things happens this week, right? And I would say, from a technical perspective, you've got the previous high from December of last year that's right around 480 on a closing basis. We have the 21-day moving average, the 50-day moving average, this breakout level around 360. Those are some potential areas of support. From a technical perspective, going into earnings, I think this is a pretty good setup, right? If you ask me to pick which way are we going to go, I mean, I think this is a chart showing more strength than weakness. This is showing accumulation, particularly the fact that we haven't broken down much in the last month. We've been sort of sideways, but we've held short-term support. I think that's very constructive. So, I mean, my sense is Tesla is a strong technical setup going into earnings this week. They report on Wednesday. However, if some of those support levels don't hold, this chart becomes very ugly very, very quickly. For now, I think it's a pretty good setup. And we obviously want to see a break to new highs. That's what continues that uptrend. All right. Shall we take a question? Boy, a lot of interesting comments here. Todd, thanks for watching on X. You said AQN, a potential cup and handle on the daily and the weekly. I'm intrigued. Let's take a look. Thanks for watching on X, by the way. Algonquin Power and Utility. So I'll tell you what, I've looked at a lot of charts, and we used to have a game at Fidelity with one of my senior analysts. It was impossible to stump him. Even stocks that had been delisted for years, he would still remember their tickers. He would remember companies that had changed tickers and could remember a couple tickers ago, because it happens. I'm not that good, but I do know a lot of charts. I don't know AQN. Algonquin Power and Utilities, a 4.8 billion market cap conventional electricity company. So says the Dow Industry Groups. Okay, we'll take a look. So not a name I'm familiar with, not a name I look at, but I would say the cup and handle pattern. I see what you're talking about on the daily chart, at least, and I'm thinking you're talking about this kind of big thing. So it certainly seems to have that configuration, right? So what makes a cup and handle pattern? We have a rounded bottoming pattern where we retest the rim. It's not perfect, but it's pretty close. We then have a shorter, shallower pullback to retest the rim yet again. The buy signal is when we break above the upper end. I mean, that's pretty close to being a classic cup and handle pattern. The only thing I would say is, remember, when you have a high yielding name like this, you usually want to look at the unadjusted data because remember, the regular price data that you look at on stock charts is adjusted for dividends, right? So when we normally look at that, what that means, a company like AQN that reports a regular dividend, a pretty decent sized dividend. The fact that the yield is 4.25% right now percent. So that means basically this company is paying out a dividend every quarter, every month, or whatever it is for that particular stock. But every time it pays out a dividend, you take the stock price down, and that's the dividend that's paid out to shareholders. So if we unadjust the data, so on stock charts, you put a little underscore before the ticker. Here you could actually deselect that button that says adjust for dividends. And when we do that, we can see we can see that it really doesn't look like a cup and handle pattern anymore. I don't really pay too much attention to that with like the average technology stock, the average growth stock, because it doesn't pay enough of a dividend to really change the configuration of the chart so much. But if you do adjust for a dividend, you can see it really isn't a great cup and handle pattern, because all of a sudden it's not really getting anywhere near up to that previous high. That's what I would say. On the weekly chart, does it look like a cup and handle? But I think you're probably talking about the same thing here. So again, if you unadjust the data, which I think is the way you want to look at AQN, if you're thinking about price patterns, I don't think it's necessarily a great cup and handle pattern. Would I think it to be a very good thing on the weekly chart if we got above like 670, which would get us above the 2024 highs, and also clear the 150-week moving average, which we've been below since April of 2022? I would. So we're pretty close where I think that chart would be pretty constructive. Also, even if you adjust the data, I think it's getting above these highs that would be most constructive. So it's like getting above 610, 620. I think it would be a pretty encouraging breakout. So again, that's a technical review. I don't know a lot about this particular stock, but that would be my assessment of the charts. Not a perfect cup and handle. Is a breakout above previous resistance meaningful? Yes, 100% yes. That'll do it for today. Thank you so much. Those of you watching as we live stream here on Monday afternoon. If you're watching the show later on our YouTube channel, hey, thank you so much as well. We didn't get to all the questions, but we will throw the remainders into the mailbag. Didn't get a mailbag episode end of last week, so we've got some really good questions queued up. We could use a couple more. What questions are you running into as you're trying to navigate these markets, navigate the meat of earnings season, and deal with an S&P yet again threatening new all-time highs? Let us know. For now, I'll say have a wonderful Monday evening. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.